Following an extraordinary gain of 77% in the 3 years that ended December 31st, 2014, U.S. stocks have taken a breather. Stocks leveled off in 2015 and through mid-April 2016. Two long-anticipated corrections followed the extraordinary run. The stock market's relentless low volatility surge was driven by a post-recession reversion to a normal valuation level. In the history-making 3-year bull run, the Standard & Poor's 500 price-to-earnings multiple expanded from deeply undervalued at 12 to somewhat overvalued at 18.2. The stock market's PE multiple of 17.4 as of April 8, 2016, was well in line with the historical norm. Trading at 17.4 times their trailing 12-month earnings, stocks were fairly valued. However, with stocks moving from deeply undervalued after the Great Recession to fairly valued during the long economic expansion, share prices are more susceptible to volatility. So, it is more important to determine that share prices are supported by economic news. Happily, the economic news is quite good. For months, U.S. government economic data releases have all been positive, and this is just some of the latest pieces of good news to come out. This is the Institute of Supply Management's Manufacturing Purchasing Managers Index. In March, it rebounded sharply. This index historically has slumped to less than 50% just as the economy enters a recession. The shaded areas in gray are times of economic recession. Notice the volatility in the manufacturing sector's momentum during periods of expansion. Keep in mind, a reading above 50 indicates the manufacturing economy is generally expanding. A reading below 50 indicates that the economy is contracting. On April 1st, ISM reported that the index in March was at 51.8%. New orders, which is a subcomponent of the index, leaped from 51.5% in February to 58.3% in March. New orders are a forward-looking component in this index. It indicates the growing level of manufacturing activity will be done in the weeks immediately ahead. That's good news. Now, let's take a look at this chart. It's also from the Institute of Supply Management. While ISM's manufacturing index gets more attention in the press, it's the index of purchasing managers in the non-manufacturing segment of the economy that is actually so much more important in gauging the strength of the U.S. economy. Manufacturing accounts for only about 10% of jobs in the U.S. economy, according to U.S. government statistics, while non-manufacturing jobs account for the other 90%. While this index has a limited history, it is calculated much the same way as the manufacturing index. It is designed to slump to less than 50 before the onset of a recession. In March, non-manufacturing PMI rose a point to 54.5, which is quite strong. The new orders component of the non-manufacturing PMI, which is a forward-looking indicator, was up for the month of March. And that is a good sign for the weeks immediately ahead. The last piece of good economic news for the week was an April 5th Labor Department news release. The number of jobs waiting to be filled fell from 5.6 million to 5.45 million in February, which was more than previously estimated. Though job openings eased in February from a 6-month high, Fritz Meyer, an independent economist whose research we license to share with you, says employers were taking on more workers. To me, this confirms other evidence of a healthy U.S. labor market. With job openings in February remaining near a record high, it's hard to argue that the economy is in trouble. But it was just a few weeks ago, in mid-February, when stocks bottomed after plunging over fears that the good economic news was ending. When you look at what's happened over the last 6 years, at all the good and bad events driving the U.S. stock market, you get a sense of the ebb and flow of progress. The ups and downs and news events since 2010 are shown in the chart above. Past performance doesn't have anything to do with your personal investment results, however. Despite the good stream of positive economic news, continued volatility is expected over the near term. Over the long run, however, you have to hope the world's slow march toward progress will continue in the years ahead, and that U.S. stock prices will continue to be the best proxy for investing in advances in civilization.